What's up? Hola mi gente, ¿cómo anda? Bienvenido a mi canal. Welcome back to the channel. So on this video, I want to give you guys an overview of what I think is happening in the market right now. I want to let you guys know where I see opportunity and what I'm doing with my investments and my cash right now. It's really important. I might be wrong on all of this. If I am, I'm sorry. But this isn't financial advice. This is just what I'm doing. This is my personal opinion. So I think I'm right. I'm pretty confident I'm right. Otherwise, I wouldn't be investing and doing the things that I'm doing. If I'm wrong, I'm going to be losing money. So, you know, I'm putting my money where my mouth is. And if you're on the Discord, you will see that every single day. I show you guys what I'm buying and selling. I give you guys screenshots. I'm as transparent as they come on YouTube. I'm not trying to pump up anything. I'm just giving you my personal opinion. And I've been doing this for over 10 years. So yeah, I'm just trying to spread the knowledge with you guys. So without further ado, let's dive into, first, let's talk about what happened last week. Then we'll talk about what I think is going to happen the upcoming week and how we can prepare for anything that's going to happen in the markets and what sectors I think are going to be the strongest over the next, let's say, 4 months. Now, before we get into the video, I am parched. I'm going to be sipping. I've been sipping on this Corona Extra. So smash that like button if you love beer. Smash that like button if you like Corona. Comment down below. Just help with the YouTube algorithm a bit. So let me drink this and then we'll proceed. We'll start talking about what happened in the stock market last week. So, yeah. Last week, we had the stock market fell a little bit, but it closed the week at record highs. So the NASDAQ and the S&P 500 have been very strong, and they're moving up and to the right. And they're breaking records, essentially. And it's been the longest time since 1998 where we haven't seen a 5% pullback on the S&P 500. Now, that's a very long time. And when you take a look at the charts for the S&P 500, the NASDAQ, and also the Dow, and you compare them to where we were pre-pandemic, and you compare them to where we were right when the pandemic happened, obviously we've had massive gains since the pandemic started. But we've also had massive gains since the pre-pandemic levels. Now, if the average return in the stock market generally is anywhere from 8 to 12%, and that's being a little bit free because, you know, liberal, because sometimes it's less than 8%. If we were to see a 10% pullback on the S&P 500, we would be at where we should be given a return on your investment if you invested right before the pandemic started. So that would indicate that we're moving as we should. Now we're high on pretty much every indicator out there, on the Schiller PE index, in every indicator out there, we're high. We're overbought in the stock market. And that's because we have so much liquidity and we can continue this trend for longer. I'm not saying that the stock market is going to pull back because of that. There are other things that are a little bit concerning, and why I think you should have cash on the side. You should have dry powder, and you should not be in margin right now, because the chances that we see some kind of a significant pullback, a correction, I don't think we're going to go into a bear market, which would be 20% drop off the highs, but we could see a correction, and we could see a sudden steep drop in the stock market, which would classify it as a crash. I know a lot of people get upset when I say correction and or crash. You can have both. You can have a crash and a correction at the same time. But yeah, I do think that there is a good chance that we are going to see a pullback. Now, what happened last week? This was all because of the 10-year Treasury yield. And the yield on the 10-year was decreasing and decreasing and decreasing. And we got as low as 1.25%. Now, it's crucial that rebounds and moves higher. And that's gonna kind of tailor into where I think investments are going to be strong, because the thesis of all of this is that we are overbought on the 10-year bonds, which is decreasing the yields. So yields are dropping, and I think that's going to reverse. It needs to reverse. Otherwise, we're going to see a significant drawdown in the market. If we break below 1.25% on the 10-year, and if we break below 1%, that's going to be catastrophic in my personal opinion, and the stock market is going to crash. So I think the 10-year is going to rebound. I think people are overbought on the 10-year, which means yields are lower, and I think we are going to reverse the course on the 10-year, and that's going to be strong for certain stocks. So moving forward, this week, we're going to have a lot of economic data coming out from the Fed, and the Fed is going to be speaking. We're going to get CPI numbers, and we're also going to hear from Fed Chair Jerome Powell, which could move the 10-year, and it could give us a better indication if they're going to be rising, rates, and if they're going to be lifting off on their asset purchases and their quantitative easing, and that will all have an impact on the market as well. Now, what I think is going to happen is the Fed's going to kind of stay put with where they are. They have been gradually increasing or bringing the timeline in on their rate hikes, but the rate hikes are so small that they're not going to have a big impact on the stock market. At least they're not going to have a big impact on the stock market financially, but you could get some kind of overreaction at first, and that could be a buying opportunity. So this week on the economic calendar, there's a lot to look at, and also we are going to get earnings in bank stocks. Which brings me to my next topic. Now, I think the financial sector is going to be a strong sector this quarter and moving forward the next 4 to, let's say, even the next year. I think the financial sector is a place that you should have exposure, and I'm overweight the financial sectors. Now, the way that I like to play my investments in these sectors is I like to buy companies that I believe in long term, and banks, for me personally, are a little bit of an old business. They don't excite me. I don't see growth in banks, and I think we are right now in a transition. And what I mean by that is I think online banks, the company that I like, Ally Financial, now I'm a customer of Ally, I love their banking system, you get the best rates. And I think that's what most people consider when they open up a savings account, like what's going to give them the best rates. And online banks are going to do it because they don't have the overhead. They're able to basically, their top line revenue, more of that's going to go to the shareholders and to the customers because they don't have all of the other expenses. So I like Ally Financial, but I like the financial sector altogether because with rates increasing, that's good for the financial sector. They're going to make more money off of these Treasury bonds and notes. Also, they passed the stress test from the Federal Reserve. So they're buying back shares. Share buybacks increase the value of your share because then there's less shares out there. So they're not diluting, they're actually taking shares away in the market, which is good for you. And they're also increasing their dividend yield. So the fact that I believe we are going to see the 10-year increase and bonds and notes increase across the board, the yields, and we are seeing share buybacks and raises in dividend yields, I think the financial sector is very strong. Where else I think is going to be strong is I think the value trade, especially the reopening trade, is going to continue to be very strong. I think the economic data that we are going to get is going to be bullish. And also, I believe over the last month or so, these kinds of stocks have been oversold and people have been moving into tech. And I think that move is overdone now, and we will see a rotation back into reopening trades. So I like reopening trades. Now, personally, the companies that I like, I don't like cruise line stocks because they put themselves in a ton of debt to stay afloat. Same with the airlines. I'm not huge on them either. But companies like Uber, which has exposure to the reopening, companies like Airbnb, which also has exposure to the reopening, and both of these companies I think have strong growth potentials and are good long-term investments, and they also give you exposure to that reopening trade. So both of those companies I am bullish on as well. Now, as far as the tech trade goes, now this is tech as in mega cap tech, which has been holding down the fort as far as the stock market goes, because they've been performing extremely well and they make up such a big holding of the S&P 500 and the NASDAQ. The company that I like these stocks still because they have tremendous momentum right now, and it's hard to break that momentum. And it's also good to get exposure to these companies. So myself personally, I have exposure to Apple, which just broke record highs and could continue to move higher. Now, I think that, tech has been trading basically inverse, or I should say large cap tech has been trading inverse of the 10-year dividend yield. And I think the 10-year yield is going to increase. And so then in theory, these mega cap tech stocks should decrease. But I don't think that's going to happen. I think that mega cap tech is going to separate itself from the 10-year Treasury yield. I think that they are going to continue to show strong momentum and they are going to move higher, while we will also see the 10-year move up. And we kind of saw that on Friday. On Friday, we saw the 10-year increase. It went from 1.25-ish to 1.33, 1.35%, if I'm not mistaken. And Apple broke its all-time high, and it looks like it's about to break out and move higher. So I think the mega cap tech stocks are going to separate. I think the 10-year is going to rebound. I think the financial sector is going to perform extremely well. And I think your value and your get out and travel trades are going to be really strong as well. Now, the sectors or the stocks that I think are going to underperform is, I think, because of the 10-year moving higher, your high flyers, your companies with valuations that are stretched, these are going to be your smaller cap, mid cap growth stocks. I think that they are going to suffer with an increase in the 10-year. And that's typically what happens with those kinds of stocks. And I don't think with all of the earnings coming in, with the strong GDP and those going into the cyclical trades and those stocks being strong on earnings, I think your growth stocks are going to suffer a little bit. And those kinds of stocks I would decrease my exposure to over the next 6 to 12 months. That's my personal opinion, at least. That's how I'm invested in this. And I forgot to mention one more sector with that get out and travel. Energy stocks will also give you exposure, and you have to keep an eye out on crude oil prices, because right now they could move way higher, and companies like Oxy, companies like ExxonMobil, those can break out to the upside and you could have really good gains there. But that's a little bit more risky because something can happen with the oil prices that can drop that down. It's based on supply and demand, and if they increase production too much, that can hurt oil prices, and that can hurt those oil stocks. But that wraps it up, mi gente. If you want to join the community, you can do so by joining the Patreon. It gives you access to the Discord server. I'll catch you guys on the next video. It's been real. It's been fun. It's been real fun. And this is We Are Investing, and together we are invincible. See ya.